Hi, welcome back. Today we are going to be talking about decoupling. Now, we are going to debunk 4 myths of decoupling. In the first place, let's explain this a little bit. Decoupling has got nothing to do with your marital status, but rather this is a rather new term that we basically hear for largely the private residential property market. Now, this is really because of the introduction of the additional buyer's stamp duty. For this, we need to go back in time. Since 2011, the Singapore government has imposed additional buyer's stamp duty for Singaporeans and SPRs buying multiple properties. This taxation is largely targeted to prevent the Singapore property market from overheating. Today, our additional buyer's stamp duty rates for Singaporeans buying multiple properties will be 12%, and for SPRs it will be 15%. In this scenario, if a couple jointly owns the first residential property and subsequently buys a second residential property, a 12% additional buyer's stamp duty is imposed on top of the usual stamp duty payable. In this case scenario, assuming the property purchase price is $1 million, the couple would have to fork out an additional $120,000 to own a second residential property. This is not ideal for many buyers. One of the legit ways to get around additional buyer's stamp duty is decoupling. This essentially means for most couples who owned the matrimonial asset jointly, one party will now transfer his or her shares solely to the other party. This leaves the first party free to purchase his or her own residential property. Now, as much as it sounds great, there are many drawbacks and considerations for us to consider. Now let's debunk the 4 myths of decoupling. As much as you do not need to pay the 12% or 15% additional buyer's stamp duty, there will be other costs for us to consider. If a couple owns the property under joint tenancy, this generally means that the party owns equal shares. If David transfers his shares to his wife Mary so that his wife can own the asset solely, the transfer will be subjected to buyer's stamp duty. Since there is no actual transaction value in this case, the buyer's stamp duty will be based on the open fair market value of the property, based on the percentage of shares transferred. Let's assume the open market value for this property is $1 million. This means when David transfers his shares to Mary, the value of the shares transferred will be $500,000. The buyer's stamp duty payable for this will be approximately $9,600. On top of that, there will also be legal fees payable, as the couple will require lawyers to do this transfer. This will cost another $6,000 to make this transfer effective. Decoupling essentially means when one party sells his shares to another party. In Singapore, majority of the purchasers would use at least some parts of their CPF funds to finance their property purchases. This means when the party sells his shares to the property, this amount of CPF that he has used would need to be refunded. In this example, if David had utilized $200,000 from his CPF to finance the first property, this amount, inclusive of accrued interest, has to be refunded back to his CPF accounts when the shares is transferred to Mary. The total amount, inclusive of accrued interest, will be approximately $220,000. Since there is no actual transaction, this amount to be refunded to David's account will be paid back in cash, unless Mary is able to secure a loan sufficient to discharge this amount back to David's CPF account. This is largely true if there is no outstanding loan. However, if your first property has got outstanding loan, then we will need to consider some early redemption penalties. Usually, For mortgage loan, during the first 3 to 5 years or during the lock-in period, there will be pre-penalties payable ranging around 1.5% on the outstanding mortgage amount. This becomes cost that we would need to consider when it comes to decoupling. Assuming the first property, which is to be decoupled, had an open market value of $1 million, and that there is an outstanding mortgage of $700,000. The early redemption penalty will be around $10,500. Additionally, we also have to consider whether Mary, who is now the sole owner of the first property, using her own individual income, would she be able to secure sufficient loan to continue financing her first property? To continue from our previous example, decoupling may not work for all households. This is because majority of decouplers out there, based on their joint income assessment, would be able to secure a higher mortgage compared to being assessed on a sole income. This means, based on individual incomes, the parties may not be able to secure sufficient mortgage loan to finance two properties separately. We are going to assume David and Mary owns a first property with an open market value of $1 million, which they are going to decouple and put it under Mary solely. They have intentions to purchase another investment property with a budget of $1 million. In this first scenario, David's gross monthly income is $15,000. Assuming he's 40 years old and currently has $3,000 monthly installments for his car, credit card bills, etc. Mary is 35 years old and earns a monthly income of $5,000. She currently has a monthly expense of $1,000. The current total debt servicing ratio, which pegs available spending at 60% of an individual's gross monthly income. Lending facilities will then need to deduct the individual's monthly expenses from the 60% limit. David's available threshold to service the monthly installments for the new property will be $6,000. Mary's available threshold on her personal capacity is $2,000. Assuming the interest rate is 3.5% and the maximum tenure is 25 years for David, the maximum loan available to him will be approximately $1.2 million. With the same assumption that interest rate is 3.5% for Mary, and because she is younger, her maximum tenure will be 30 years. The maximum amount of loan available to her will be $445,000. For Mary, since she is the sole owner of the first property now, she will need to secure a second mortgage on her own to pay off the first outstanding loan. Assuming the outstanding mortgage of the first property is $700,000, but she could only secure $445,000 now. This would mean the shortfall will either be paid by cash or if she has CPF in her account. This amounts to $255,000. Out of this, $220,000 will be paid to David's CPF account and $35,000 to discharge the first mortgage loan redeemed. This means for David, it would be more than sufficient for him to get a loan to finance this second investment property. In Singapore, the loan-to-value ratio is 75%. In this case, since the purchase price is $1 million, the maximum loan he can secure will be $750,000. The remaining 20% will be from his refunded CPF. And 5% of the purchase price will be payable by cash. Buyer stamp duty will also be payable. This amounts to $24,600. Since David has another $20,000 in his CPF, which was refunded from the decoupling, he can use this to pay off part of the stamp duty. Legal fees will be payable by cash. Hence, the total amount of cash he needs for this purchase will be $57,600. In this first scenario, the cash outlay needed for the couple to decouple the first property first is $251,000. The cash required for the second purchase will be $57,000. In summary, for this couple's profile, the total cash outlay to decouple before purchasing the second property will be approximately $320,000. In the second scenario, we are going to see what happens if the couple earns equal income. If the couple each earns $10,000 per month, given the same assumption as the previous example, the loan available to David individually would be $600,000. While Mary, because her monthly expenses is lower than David, she would be able to secure higher loan. Mary, in her personal capacity, will be able to secure up to $1.1 million loan. This means Mary, on her own capacity, will be able to secure sufficient loan to finance the first property on her own. Since the outstanding loan is $700,000, the maximum amount of loan based on 75% loan-to-value ratio will be $525,000. Assuming she does not have any excess money in her own CPF account, she will need to come up with 25% cash. This would mean $175,000 in cash, which would similarly be used to offset back into David's CPF account. Since David is only able to secure a $600,000 loan instead, the amount of cash he will require to purchase the second property will be more. If David uses the $220,000 refunded CPF in his account, this would mean he will still need to come up with approximately $180,000 in cash. Buyer's stamp duty will also be payable by cash. Similarly, legal fees of approximately $3,000 will be payable by cash too. In all, his total cash outlay to purchase this second property will be approximately $210,000. For this second scenario, the cash outlay for the couple will be $200,000 to redeem the first loan, and David, with his personal loan capacity, will require approximately another $200,000 in cash to purchase the second property. For this stimulation, the total cash required for decoupling and purchasing a second property will be approximately $400,000. If David and Mary remain status quo, jointly owning the first property without decoupling, and jointly buying the second property, the downside is that this will be deemed as the second property loaned, which means instead of an LTV ratio of 75%, it will now be 45% instead. But the upside will be that the loan will be assessed based on joint incomes. Let's assume the couple does not have excess in their CPF accounts. The cash outlay will be then $550,000 for the shortfall not covered by CPF. The usual buyer's stamp duty and legal fees will now also be payable by cash. Since it is a second residential property, additional buyer's stamp duty will now be payable. For this stimulation, the total cash outlay will be almost $700,000. In the third scenario, David's income is $15,000 and Mary's income is $5,000. They have now, however, fully paid off the first property loan, and David have similarly used $220,000 from his CPF to finance the first home. When the first property is decoupled, there will be no outstanding loan to be paid off. Hence, this means Mary do not need to secure another loan to discharge liabilities for any outstanding loans. For this stimulation, the cash component will be merely the amount that is to be refunded to David's CPF, as well as the other cost of decoupling. Similarly, for the second property, Since David is able to secure the maximum loan of $750,000, the shortfall of $250,000 can be payable by cash or CPF. If David uses the refunded CPF in his account, this would mean the total cash outlay, inclusive of taxes, will be $57,000. In this last simulation, even if the first property has no outstanding loan, the total cash outlay required to decouple before purchasing the second property is almost $350,000. If David and Mary remain status quo, with no outstanding loan for the first property, the advantage is that they will still be able to jointly secure a 75% loan-to-value ratio. Since this is the second residential property, a 12% additional buyer's stamp duty will be payable. In this last simulation, assuming the couple has no excess CPF in their accounts, they will need to have 25% cash, and the usual buyer's stamp duty and legal fees apply. This time round, they will also need to pay $120,000 as additional buyer's stamp duty. This means the total cash outlay without decoupling will be around $400,000. Whether decoupling works or whether it is a cost-savvy approach will largely depend on the individual's profile and situation. Things such as income, their monthly expenses, whether they have used CPF to finance their previous property purchases have to actually be taken into account as well. See you in the next tutorial.